Hello, 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 and welcome to this evening's call. So this is the Katana Property Channel, episode number 9, I believe, and how quickly these are flying by. This might even be episode number 10. This is episode number 10. Insane. Things have moved by so swiftly. So, firstly, just to check in, I just want to make sure you guys can hear me and see me, and as per usual, please give us a quick comment on the chat box just to let us know that you can hear me. And I firstly want to say a huge thank you very much for tuning in this evening. We should be in for an interesting evening. We're going to be talking a little bit about how to be able to make sure you get the most money from your portfolio possible while by reducing some of your taxes. Oh, there we go. Okay. It looked like we had a bit of an internet blip there for a second, but it looks like we're back up and rock and rolling. So, yes, so just want to check in, make sure you guys can all hear us okay. So please do give me a quick comment in the chat box. So we're on Facebook and YouTube live at the same time. Okay, super cool. Right, okay, so exactly as I say, we're going to be working on how you can get the most money from your portfolio. And the way in which we're going to be talking about this is we're going to talk about investing in a personal name or investing in a limited company. Pros and cons to both. We're going to talk a little bit more in depth about those and how that all works. Hey, Imogen, awesome to have you on. Super cool. Hello. And also Ashu and Julia, awesome to have you guys on. Thank you very much for joining the stream. It should be an interesting session for you guys, so I hope you enjoy it. Okay, so some of the things we're going to talk about is which one's better. So investing in a limited company or investing through a limited company or investing through your personal name. Second thing is how taxing works for your personal name against the limited company, so your typical taxing. Apologies for the buffering over on YouTube. If you shoot over to Facebook, it should be a little bit better, less buffering. Maybe a couple of seconds delay though. Then taxing works within a limited company. Section 24. Okay, Section 24. It's a big thing that the government brought in recently. So we'll be discussing a little bit about that and how that whole thing works. That's really interesting, by the way, and how that affects you as an investor. Hey, Gavin, awesome to have you on, buddy. Thank you very much for joining in. Love the fact that you're on as well, dude. But yes, then also working out which is better, and then when thinking of switching from personal to limited. So if you already have a portfolio in your personal name, being able to switch it across to a limited company. Hey, Alex, awesome to have you in, dude. Cool for you to join, man. Thanks for joining. Awesome, you guys we're getting a good group of people in. Okay, and then lending money in and how that works. So how you lend your money via your company, how that all works in terms of tax benefits, tax savings, etc. Okay, and then finally, we're also going to do a couple of exercises which I always love to wrap up on. Those of you that know me, and those of you that have caught a few of these streams before, if you've caught the stream before out of interest, just give us a 1 in the chat box if you've caught our streams before and you've watched some of these before. Just give us a 1 in the chat box. It's interesting to see who's actually tuned in again. So please do. Okay, so let's get kicked off. Let's start to go into the juicy bits of the conversation, the juicy bits of what we're covering. So first of all, investing in personal name versus investing in a limited company. Yeah, awesome. Awesome to have you in as well, Mike. Thanks for joining. So investing in personal name and investing in a limited company. Now, before I go through this section, I think it's important that you guys are aware I am not a tax advisor, okay? I am not giving you tax advice or financial advice in any way. I have to tell you this for legal purposes. However, what I am going to do is I'm going to tell you some of the things that we've done and we've employed through the guidance and through the help of our tax advisors that has helped us in our business. And in the same way, you can potentially look at it, including these sort of structures and strategies within your portfolio growth, which will really help you move along. Okay, awesome. So buying in a company and buying a personal name. So there's a whole bunch of legislation and stuff out there which is inhibiting people from buying property in personal name and making it a little bit more challenging. And something that you're going to be able to notice and you're going to see is it's as though with all the new government changes, all the regulation changes, the government is trying to move people from investing in property through personal name, so more often than not accidental landlords, moving them into building portfolios in limited companies. Now let me explain the purpose of this. Okay, the purpose of this very simply is they want to professionalize the industry. Because if you understand, if you're investing in property through your personal name, there's a lot of people who don't correctly pay their taxes. So they'll receive the money as cash, and they won't be paying their taxes in the way they likely should. Okay, so due to that, what the government has done is they've said, well, how do we ensure that we earn more taxes? And the way they do that is they've professionalized in the industry. So this means that a lot of people, a lot of landlords, okay, that have built portfolios in their personal name are either being pushed out of the industry or they're being forced to professionalize what they're doing. So please understand the vast majority of rogue landlords, or what are deemed as rogue landlords, are generally situated around the London area. Not all, but the vast majority, just because of the amount of rent you can receive per, like, for the space that you have. So they've made the spaces smaller and smaller and smaller and less adequate for tenants, and therefore they've allowed themselves to get more and more rent. Obviously, the government isn't happy with this, so they're trying to push out some of the rogue landlords that do this kind of thing. Okay. Now, in terms of how a lot of investing has happened in personal name, so the vast majority of people, when they invested in property in their personal name, what they would do is they would just literally just buy the property under their name and no other name whatsoever. Okay, so under their name, no other name whatsoever. So no limited companies, no anything like that, which has some benefits. Okay, let me explain. It has some benefits because by owning a property in your personal name, it makes it much easier for you to be able to, complete all your legal agreements because there's no extra paperwork. It is purely you who's signing. You don't tend to get all the personal guarantee stuff because that is included within the agreements. Okay, so your cost of legals, your cost of finance tends to be a little bit less expensive. Not only that, typical mortgage lenders are much more accustomed to lending to a personal name investor as opposed to lending to limited company investors. So if you're a limited company, understand that that is another barrier between the lender and you. Okay, and you are ultimately the person they want the security against, as well as the property, so that they can make sure their backside is covered. So that's the typical way in which personal investing works. Now, buying in a limited company is a little bit more different, a little bit more catered. So what you would do is you would create a limited company, and they're very simple to create. For those of you that don't know or haven't created a company before, it's actually as simple as spending about 5 minutes on Companies House and registering some information, registering the company type, registering the shares, the share type, etc. And then you hit go, and that's a £15 payment, and the company gets set up. Now, please understand, if you do not do this correctly, it can be a little bit of a pain in the backside to get rectified. So how most people set up limited companies, they end up going via their accountant. It may or may not be the best idea. For those of you that have set up a company through your accountant will know they typically charge like £350, £400 for something that in effect takes them about 15, 20 minutes. I'm not overly happy with how that works. You do get companies that are good at opening companies, and they will do it for significantly less. So we pay £70 through the one that we deal with right now, and she is wonderful, and she does an amazing job. Everything set up. They do our annual filings and all of that sort of good stuff. So creating a limited company is particularly simple in the UK. The bigger challenge tends to be creating the bank account for the limited company. Now, if you're a UK resident, you can typically go to the bank that you bank with and say, look, I've just launched this business. Can you do it for us? You've done it limited. Good stuff, Gav. Good stuff, buddy. But you could say to them, I already have this bank account with you guys. I've just created a limited company. Can I get an account? And they'll create one in a number of weeks, and off you go. However, if you're an international looking to invest in the UK, it tends to be significantly harder to create a limited company over here. Okay, and being able to create a limited company over here tends to have a lot more hoops to jump through, and they don't tend to, has the sound gone? Hopefully not, Jessica. Out of interest, can you guys all hear me? I just want to check in to make sure you guys can all hear me. Had somebody query the sound. If you can't hear me, it might be an idea just to refresh the page, and then you should be able to get it back there, Jessica. Awesome to have you on, by the way. Thank you for joining. Okay. So as an international, it's much harder to be able to create the limited company here in the UK. So the easiest, okay, swapped internet connection, no worries. Okay, so the easiest way to be able to actually set that up is you want to go through, there's certain companies, bespoke companies that can assist. Kevin, can you scroll down on the Facebook side there, please, on the comments? Facebook side, there we go, thank you. So you actually get companies that assist you as an international to open bank accounts over here, and you get some really cool ways in which some of them do that as well. There's a company called GetGround, by the way, GetGround, which research online. It's an online tech business. They're amazing with all the account stuff. They create one company per property, which can get a little bit more expensive, but the thing I really like about them is they have an automated accounting package, so it does all the finance and accounting for the properties, nice and simple, nice and easy. Really, really cool, really useful. Highly, highly recommend them. But for those of you that are internationals, you also have the ability to open online banks. Okay, online banks. Excuse me, I'm going to sneeze. Pardon me. So you have the ability to create some online banks. So you've got like Tide, Revolut, Starling. You've got a whole bunch of these that are actually not too difficult as internationals to open. Now, the beauty about these is the banks and the lenders in the UK have now started to open the door and accept the online banks, and therefore it makes this a viable option for you as an international, so you don't have the major headache of having to open an account in the UK as being the big challenge. Now, once you've actually got that done and you've got the account all set up, you're in a position that you can start to get lending. You can apply for finance, buy the properties, etc. Please understand, as an international, buying property in your own personal name, if you ever intend on getting finance, is not a good idea. Okay, you won't be able to get finance if you buy it in your personal name as an international. Okay, my suggestion is only if you're a UK resident would you ever buy in personal name, and I would avoid that anyway for any investment properties going forward. So always aim to stick this through a company and get a good accountant who will be able to deal with all your accounts and filings and stuff like that. Okay, now the downfalls of opening a company tend to be that your cost of lending, your cost of borrowing tends to be a little bit higher. Okay, your cost of borrowing tends to be a little bit higher in the sense that instead of paying, say, as a 3% interest, you might be paying, say, a 3.5% interest. So it's not a great deal higher, and it's actually coming more and more in line as opposed to 2 years ago when it was a massive disparity. So it's one of those things, if you just sort of stick it in, the price. It's a terrible phrase. If you just stick it out, the amount that you're paying tends to come a little bit more balanced, a little bit more even. So this means even as an international investor, it makes it pretty easy. Now, as a couple of side notes, in terms of lending, so if you're buying properties in the UK, as a UK resident, okay, you can buy properties with a end value, so a refinanceable value of around 50,000 or more. Okay, it has to be higher than 50,000. As an international, you need to be higher than 70,000 as of today. Any less means that your lending amount will be too small, and therefore you'll struggle to get lending. Okay, so that's the general basis of buying properties in companies and personal names. Now, this is where it starts to get a little bit more interesting, because when you buy a property in a personal name, in terms of the tax write-offs you can typically get, now understand I say typically because I'm not a tax advisor, I'm only talking to you from experience, okay, that you typically get is the fact that you can offset the rents, and it used to be you can offset the rents against a couple of your overheads that it would cost to actually run the property, okay, typically, as well as the mortgage. Now, there's a new thing that's been brought in called Section 24, and that's been brought in over the last couple of years, and I believe it's this year that it comes to its finality, where you can no longer claim any percentage of your mortgage payment against your income in a personal name on your portfolio. So this is one of the biggest reasons why people have decided to professionalize and move more into building a portfolio through a limited company. Now, some of the big benefits of building a portfolio through a limited company is your tax benefits. Okay, because understand, if you do things in a personal name, so anything in a personal name, any income in a personal name, I'm going to do some flip chart work over here. Well, instead of flip chart, I'm going to do some iPad work. And you guys should hopefully see what I'm writing right up behind me. Although you might see it through my shirt, because believe it or not, this is yellow, but on a green screen, it's not so yellow. So, but yeah, so if you take a look, the way in which it typically works is personal. Okay, and that should pop through. Okay, so you have your earnings. Okay, and then they take the tax. Then after they take your tax, then you have your actual income that you can play with. So what's left over. Okay, so this is the typical way in which it works. Now, when you do it through a limited company, this is where things start to get a little bit more interesting. Okay, so limited co. Okay, you have your earnings, so whatever the gross earnings are of the business. Okay, then, okay, and only then do you deduct expenses. Okay, and then you pay the tax afterwards. Now, your expenses are included within your income. Okay, so if I do this in a slightly different way, just to make this make a little bit more sense, you'll see exactly what I mean. Okay, so let me just delete some of this stuff. Okay, so in personal name, typically you'd have gross income, okay, minus tax, then minus expenses, and then that equals your money. Okay, that's your money. That's the amount of money you can physically play with. Now, if you take a look at it in the same way in terms of a limited company, okay, this is where it starts to get a little bit interesting, because you have your gross income minus your expenses, then you minus your tax afterwards, and that equals your money. Okay, now this is where, let me explain how this makes sense. Okay, let me explain how this makes sense. So let's just say your tax in this instance accounts for 20%, just for the interest of the exercise. Okay. Okay, and let's just say your expenses are, I don't know, 5,000. And then your gross income is 10K. It's 10,000. And then I will explain how this works. So you got your 10K and you minus 20%. Now 20% of 10,000, obviously, as you'll know, is 2,000. Okay, so basically at this point you're minusing 2K. Okay, and then you minus the 5K, gives you a total amount of money left over of 3K, as an example. Okay, now 3K you might go, okay, well that's not terrible after you take into account all your expenses for running the business. But if you do the same thing with the limited company, you do your 10K minus 5K. Okay, so minus your 5K, okay, and then minus 20% of what is left. Okay, so at this point, you're only paying 20% on 5K instead of 20% on 10K, which means this is only 1K now, which leaves you a net total of 4K. That means you've just made an extra £1,000, okay, that month purely by running this through your business as opposed to running this in personal name. So in terms of what you can do and can't do within your business, okay, is you get very savvy with what some of your expenses are. And this is where it starts to get really, really interesting. Because if you have some expenses, understand that you'll have expenses such as, your home office. You'll have expenses such as a percentage of your broadband, percentage of your gas, food, like gas, water, and electric. You'll have a percentage of food, so you'll have an allowance for food every day. You'll also have an allowance for fuel. You'll have an allowance for travel. You'll have an allowance for, let's say, a guard dog. You'll have an allowance for the food for the guard dog and their vet bills. Okay, you understand you have a lot of things that you already pay in your daily life as a standard necessity payment, where a percentage of that could be accounted for as actual business expenses, and therefore the amount of expense that you have would then be increased, and therefore the amount of money you receive every month more, because you'd be paying less of tax. Okay, because the higher your expenses are, the lower your tax bill. I hope this makes a lot of sense to you guys. If it doesn't make sense, do just say in the chat. More than happy to go over this again. But this for me is really interesting. Now, I understand tax is never fun or exciting, but when you start to understand that the real challenge is not earning money. Making money is super simple, let me be clear. Making money is super simple. The problem is not making money. The problem is actually keeping the money. Okay, and the easiest way to do that is make sure you are efficient with what you should be paying on tax. Pay all the taxes you are due to pay, and pay legitimately, but don't pay more than you need to. It makes no sense. Okay, if you want it to be charitable, don't be charitable to the government. I promise you they're doing okay. Okay, be charitable to people who really need it. And the easiest way to do that is make sure you don't overpay on taxes. And that's what this whole thing's all about. Okay. Now, obviously we've gone through section 24 in here as well. Understand that as part of your expenses here, let's just say all of these expenses just in this point were just mortgages. So you used to be able to deduct that against your tax bill. Okay, so instead of you paying, so you'd only then pay 80% of that in tax. Okay, that of those expenses. So 1K of that would have come off your tax bill, and that would have been really useful. Nowadays, that's not the case anymore. Okay, so the section 24 has made it really difficult for those of you being landlords in your personal name to maintain that. It's made it much more an easier industry to build a portfolio in a limited company. Now, I want to show you something really cool. Now, this is the real juicy bit, and I want you to pay close attention here, because this is very, very interesting and very useful. Okay, so if you consider, there is you, okay, you are a legal entity. By having a birth certificate here in the UK, let me be completely clear, you are registered as the property or as an employee, technically, of the Corporation of the Great Britain. Okay, you are an employee or a legal entity as far as they're concerned. You're not even yourself. Let me be clear. You do not own yourself. The government own you. This is how this whole thing works. Unfortunately, that's what a birth certificate is. Okay, and as part of this, you being a legal entity, you will also then create a limited company. Okay, a limited company. That is equally a completely separate legal entity, as though it is a person. Okay, this is corporate law. This is how it works. Now, if you lend money to your company, how would your company be able to start building the portfolio? How would you build a portfolio out of interest? Okay, would it miraculously make money out of thin air, or would it have to have some seed capital originally? And I'm looking for a response on this, by the way. Okay, how would your company get its original seed capital, its original money from? Where would that come from? Okay, exactly right. Okay, so this would then come from a loan from you. Okay, you would have to be the seed capital. You would have to. This is the only way it works. So let's just say you loan your money or loan your company 100K, as an example. Okay, again, let me be clear, this is not tax advice, this is guidance. Okay, it's interesting. So you loan your money, or you loan your company 100K. This is deemed as a director's loan. Now, please understand, a loan is not taxable here in the UK. A loan is not taxable. Apparently a mortgage is, but a loan is not taxable. So you lend your company 100K, there's no tax to pay, and that's a loan. Okay? Wow, YouTube seems to have crashed up a little bit. There we go. Facebook. There we go. Now, understand that all the time your company is making money, okay, so all the time it goes from £0 profit all the way down to 100K profit. While it is either paying off the loan or reinvesting that money against the loan, okay, that is not taxable. I'm sure some of you accountants out there might try and naysay me, and some of you may be right in how you approach it, but from my understanding, this is not taxable. Okay? Because this money is not actually profit. It's not actually profit. The business isn't making profit. It is repaying a debt, so therefore it is still negative. Until it surpasses 100,000, that is still not profit because it's a debt. Okay? And until your company has repaid you the full 100K, obviously anything it earns over that 100K is then moving into profit, let me be clear. Okay, but anything short of that, until it pays you over 100K, okay, against your director's loan account that the company owes you, this is equally not taxable. Okay, keeps buffering. I'll have to catch recording. Sorry about the buffering, John. Unfortunately, we're running on a higher stream rate, but apparently we're running, so it's good. That's what matters. Okay, so this is where it's interesting, right? So until your portfolio in your limited company makes over 100 or over the amount you've invested back in profit, okay, it is therefore still in debt, and therefore it's still deemed as company losses, and therefore, as company losses, you don't pay tax. You don't pay tax on losses. You pay tax on profits. Okay, and then while the company pays you back your entire 100K through the profits that it's making, okay, everything that is going from the limited company through to you until it surpasses 100K is equally not taxable because it is repaying a loan. Okay, it is still a debt. Now the real question is, and this is the real question, when is it going to pay back the 100K? Okay, when is it going to pay back the 100K? Or is it going to continue to recycle that money with the portfolio to continue to build the portfolio? Okay. Yes, Alex, 1 second. Okay, you can continue to rebuild or keep recycling that money within the portfolio, so it keeps being reinvested instead of being taken out or showing as a profit. It keeps being reinvested, and therefore it is still not deemed as a profit. Okay, so your company will pay very little tax, pretty much no tax, providing your accountant does a good job. Your company will pay pretty much no tax because it is not making any money. Okay, let me be clear. It's not making money in this example. It is not making money. And you can't pay tax on money you haven't made. The government only charges you tax on income, on profits. And then once you get to a point that you are you've done what you need to do and you've built your portfolio and you're relaxed and everything like that, it's only at this point that you're going to then repay your director's loan. Now, is there anything stopping you? Okay, is there anything stopping you? And this is sort of the cheeky stuff. Now, it's obviously legitimate. It's a genuine loophole, and it's legitimate. And right now, as of today, it still works. Is there anything stopping you going and viewing, say, properties in Spain to go and see if there's any to buy, and it just so happens that you end up taking a 2-week holiday while you're out there? Is there anything stopping you doing something like that? Okay, legitimately. Okay, and the answer is no. Okay, no. And therefore, in the same breath, is there anything stopping you hiring a car to be able to go and see something? Is there anything stopping you going on business meetings where you just so happen to go and play around a golf in Turkey? You understand that there's a lot of things that you can do that are legitimate business expenses, and just be careful, because if you sail too close to the taxman might start asking some questions, and you have to do things legitimately. Okay, you obviously make sure that your tax accountant's okay with what you're doing. On a side note, with regards to tax accountants, please make sure you get a property-specific tax accountant who is good. Okay, highly, not just my Uncle Bob who owns one house has said it's a good idea. We want it to be highly recommended tax accountants, because otherwise you just, you get what you pay for with accountants. Okay, you get what you pay for with tax advice. Kev, scroll, buddy. Okay, lovely. Okay, so what inevitably ends up happening then is, instead of you getting back just 100K, you're obviously going to be utilizing a lot of this money to be able to pay for certain expenses that you pay. So fuel in your car, parts like your insurance for your business car, office space, etc., etc., etc. So instead of you receiving 100K back, okay, because of all the deductibles and everything like that, you have every ability to potentially earn over 250K back without having to pay extra tax on it. Okay, now this is the kind of stuff that I love about business, and this is the kind of stuff I like about property, because you can coincide the two together, and because the way in which property works, you are spending a lot of time reinvesting that money into the portfolio, and therefore the portfolio is never in a profit, technically, until you stop investing. Okay, and the question is, when do you want to stop investing? Okay, that's the $1 million question, right? Because only there is it when you have to start worrying about the tax. Has to be wholly and exclusively for business. Don't think you can put a family holiday through. Not a family holiday, but yes, Kathy, you're 100% right. So not a family holiday, but if you have to take a trip over there to go see some properties, and it just so happens to coincide, potentially you could put your flights through there. Maybe not the whole families, let me be clear. You don't want to take the mick, okay? Don't take the piss. But there's certain things you can get away with that the vast majority of people don't realize. This is where a really good accountant can come in and really help you out. But yes, 100% agree. Okay. Now, let me ask, who found this useful, out of interest? If you found this useful, just give me a 3 in the chat box if you found this useful and you think, this is pretty cool, and it's something that I like and I might implement within my business. If you found this useful, just give me a number 3 in the chat box. Just sort of want to check in and just sort of make sure you guys are getting some value from this. So for this, I appreciate it's tax, which is a very boring subject, but this for me is a brilliant, brilliant little way in which you can earn more money and actually spend less money. There we go, my yellow shirt is invisible. Okay, and spend less money. Okay, awesome. Absolutely love it, guys. Awesome. Okay, super cool. So, right. Now, so that's the whole thing with regards to how you can offset as many taxes as possible against your company. Love the fact that my T-shirt is invisible to some of the numbers. So it's super cool. Right, okay, so I'm going to give you guys a couple of exercises to sort of finish the stream. I love to try and keep these fairly short. But before I do, has anybody got any questions on anything we've covered today, or any questions on anything at all? Okay. Yeah. So when you do your business trips or meetings, exactly as you say, Colin, make sure you take the minutes. Okay. So take your board minutes or whatever it is that you're going to be doing out there, because of course you want to make sure that there is legitimate business purpose in doing it. You're not just there trying to take the mick out of the government. They don't tend to like it if they feel like you're taking the piss. Let me be clear. Okay. But there is things you can do legitimately. Okay, but in the meantime, if you've got any questions, please do pop it in the chat box. I'm more than happy to answer. If you enjoyed that and you got some value from that, please do me a favor, just hit the like button on the video or hit the heart or whatever it is that you have available in front of you, depending on what platform. And I'd love you guys to share the video, share the stream. I want to keep getting these videos out there to other people to try and make sure that they don't pay more tax than they need to. Okay, for director's loans, please let me know before gross profit or after net profit. Okay, so director's loan, understand, it depends on how you, so just making sure that I'm clear on the question. So when you have your net profit of the business, so then the business after all of the business expenses, okay, and then that comes out as director's loan, okay, that would be against your director's loan. Okay, that's the bit. Okay, now the beauty is obviously the business is going to be expending a lot of stuff for you that you would be doing in your average everyday life as part of your business life. I'm in London for meetings probably 3 days a week, etc. So all of my travel, all of that stuff is all included within my business expense. And then I try and coincide the occasional lunch with my brother or a friend while I'm in London. And it just so happens that that all falls within my work day. Okay, got a couple of really cool questions coming through right now. Okay, so question, when you're ready, have you found a tax efficient way to move personally owned property into a limited company? Yes, Andy. Okay, so there is a way in which you can do that. The way in which you need to do that is you need to move the personally owned property into something called an LLP or an LLC, so limited liability partnership or limited liability company. Again, let me be clear, I'm not a tax advisor. This is what I've heard from my tax advisor. Okay, once you move it into that company, after 2 years of running it as that, if you can then evidence that you've ran this portfolio as a business, they will enable you to incorporate that, so move it from an LLP or LLC into a limited company. Once it becomes a limited company, on both of these transactions, there is no stamp to pay. There will be legal fees. Okay, let me be clear, there will be legal fees. So it depends on the size of your portfolio. If you have a larger portfolio or a higher value portfolio, this makes sense. If you've got a portfolio of 100 or 200,000, I'm not so sure it would make a great deal of sense. So it purely depends on your portfolio. Now, please understand, again, you want to be speaking to your tax-specific accountant and tax advisor to be able to help you with this. This is a really good one. Okay, Nishil, also on Facebook question, what tax is paid back when the loan is paid back? So again, it depends on your personal circumstances, your tax banding. So it's a little bit of a tricky question, but basically, depending on your tax banding, you'd be paying back money based on the profits you receive from the business. Now, fortunately for me, my business pays for a lot of stuff, including parts of my home, etc., like that. So my profits from the business doesn't have to be anywhere near as high, because my living expenses doesn't have to be anywhere near as high. I hope that makes sense and answers your question. For the director's loan, does that need to be paid for purpose, i.e., do you draw up a contract with your limited company? Typically, no. It's normally just recorded on your balance sheet. It's the easiest way to record it, just typically on your balance sheet. Obviously, there can be some variance. And for those of you on YouTube, I will answer in a second. Sorry, I'm just doing Facebook, and then I'll switch over to YouTube. Otherwise, I'm going to get lost. And I had a question earlier from Alex with regards to, can you charge an interest to your own company to further benefit? Only if the money you are putting into the company costs you an interest. And then you can only charge that percentage of interest. Okay, so if you borrow your money from your mum and she's charging you 5%, and that's what you put into your company, okay, then you can charge 5%. I'll let you read between whatever grey lines you need to read between on that. I'm not going to delve any further there. Okay, next question. So I'll shoot the reclaim amount. So basically, the amount that you reclaim is, it would be the same as what you take as in the same sort of way. So anything that is left over, you could reclaim against the amount of money you've invested into your company. Okay, and basically you'd only be paying tax on everything over and above the original investment amount that you've actually reclaimed back. Sorry about the buffering that you guys are getting on YouTube, guys. Okay, then while recycling the 100K director's loan, the company is classed as one not making profit. How can the company then get further loans from the bank to find more deals? So the banks don't tend to look at the profitability of your business. They look at the profitability of the deal. Okay, when it comes to mortgages, they don't tend to be looking at you. It's much more about the deal and much more about you personally as opposed to the company, because you will be signing a personal guarantee on behalf of the company. Okay, and unfortunately, there's no way to get around it until your portfolio gets to a certain size where the bank no longer feels they require your personal guarantee. Hopefully that answered your question there, Katana. Really good question, by the way. Really good question. Okay. If you guys have got more questions, please just ask. I'm more than happy to answer. Again, I'm not a tax advisor. I have to keep saying this because I don't want any of you to say, well, Rich was giving me this tax advice and blah. I'm not a tax advisor. I'm just giving you guidance from what I understand and what I've been told. Feel free to verify everything you've heard with your tax accountant or your tax advisor. Again, make sure it's property specific. Please understand, okay, please understand it's important. Not all accountants are made the same. Not all tax advisors are made the same. They are within a regulated industry, and some are more worried about making sure their backside is covered than saving you in taxes, okay? Because they don't want the hassle of getting an inquiry into their business from HMRC. So just make sure that you pick the right accountant for you and your risk profile, okay? If you have a higher risk profile like me, I'm more willing to take risk. It's why I found myself in trouble all those years ago from the railway, as you guys that know me will have heard the story and be able to find online. Yeah, that's why I ended up in trouble. So, you know, that's it was a massive learning for me in understanding how tax actually works to ensure I don't end up in the same position. I made sure that I got full understanding of how the whole thing operates. That's how I can give you guys some guidance right now. Okay, how will a company get to a certain size if every deal done if every deal is done under a different company? Okay, so John, really good question. So that's all to do with the get ground strategy or the get ground structure. It depends. So you don't have to follow the get ground model. You can actually create your own SPV, have as many properties as you want in there. Okay, it's completely down to you. One of the biggest benefits of sticking a property into a company is the reduction in inheritance tax. Because instead of you having to then give the property to the family member, okay, they get shares in the company. Significantly easier model, significantly less expensive, okay? So really good question there, John. Hopefully that answers your question. Any way of getting a lender to drop the debenture demands? No. Get your portfolio to a certain size, maybe, but typically no, Colin, unfortunately not. The reason they do that is for their security. Understand a bank is belt and braces, and they will happily pull your pants down on every opportunity just to make sure their ass is covered. So unfortunately not. I wish I could say yes. It's a conversation with your broker, though, because they might have some lenders that aren't so fussy about it, but typically they will pretty much all ask for that, especially the larger lenders. Okay, Nishil, what would you say are the best questions to ask to find the best tax advisors? So for me, the questions are typically, who are their typical clients? What sort of portfolio size? Are they property specific, or do they tend to deal with a little bit of everything? Do they dabble? Also, when you say, you know, I'm looking to sell very close to the wind, how comfortable are they with that? And how do they tend to do it? Look, there's an array of questions, and you just try and get a bit of a feel for the accountant. Now, unfortunately, there's a lot of variance in it. It's a really good question. It's difficult. I mean, we use an amazing tax accountant, a chap called Andrew, and he does a wonderful job, as well as looking with Get Ground, who are good, but I mean, they won't give you the same sort of level of tax advice. They'll give you what's called tax guidance. Okay. Wow, we seem to be buffering a lot today, so my apologies for the buffering, guys. Hopefully you can still hear me while it's busy buffering in the background. Okay, right, so Kev, can you just scroll down on both, just make sure we've got both covered? Okay, so excellent, and then also on YouTube, please. Okay, cool. Right, okay, great, thank you. Take your own tax advice, 100%. 100%, Ashu. I wish I had me before I made my mistakes with the taxman. And ironically, it wasn't even mistakes with the taxman. I was in a position where I lost a contract, lost my ability to earn money, and the money I had aside for tax is what I used to feed my family. Apparently, the taxman prefers that they get paid rather than you feed your family. They would rather you starve than not pay them. And that was the issue that I faced as part of my whole tax thing. Beauty about losing work. But yes, okay, well, I mean, it looks like you guys are looking pretty good. So I'm going to give you guys your exercise now so you guys can get on with your evening. The exercise is, first, I want you to consider where you would build your portfolio. Okay, make a decision. Would you build it in personal name or in a limited company? And why? So write down why. Have a bit of a think about it. Second thing is look at the difference between inheritance tax or how much you'd be paying in inheritance tax for paying or for transferring property to family from personal name and transferring from a limited company to personal name. Really interesting. Okay, really fascinating. Have a bit of a look at that. Okay, and then the third thing is I want you to look for some property-specific tax advisors for your journey. Now, you don't have to instruct them. Just have some conversations, get the feelers out, try and get to know some. Speak to at least 5. You'll get a much better feel for one or the other. Now, if you are inherently a very risk-averse person where you struggle to take risk, you like to take the very safe route, I'll be very clear with you. You are going to pay more tax. Okay, it is going to cost you more money. It is going to be harder to earn money. However, it is very unlikely that the negative things will happen that you could worry about. Whereas if you are a risk taker like me, I'm very much a risk taker. Calculated risks always. I try not to go bullshit, and I try not to be gung ho or wild. But if you're a risk taker, you'll pay significantly less tax, typically providing you have the right accountant and tax advisor. But please understand that be careful of how close you sail to the wind. There's nothing wrong with bending some rules. Okay, let me be clear. There's nothing wrong with bending some rules. Don't break them. Okay, it is never worth breaking rules. Okay, it is never ever worth breaking rules. So bend them as far as you possibly can. Just don't break them. Okay, my business coach once said to me, "It is never worth going to jail for money," and I completely agree. And it's probably the best advice I've heard in my entire life. It's never worth going to jail for money. So that sort of brings us to the end of the stream. I hope you guys have had loads and loads of value. You've thoroughly enjoyed what we've covered. Like I say, if you guys have had some value, you've had some enjoyment out of everything, please do me a favor. Please give me a like. Please give me a share. Get this out to your friends. And then give me a comment in the chat box saying thanks. That's all I want. A nice simple thanks. And it's not a thanks for me. It's to get the comments up and also to show that what we're doing is giving you guys some value and you're actually enjoying it. Okay, off the back of that, then what I'll do is I'll make sure we cater to a lot more of this going forward. But in the meantime, thank you very much, each and every single one of you, for your time. Thoroughly enjoyed it. I look forward to catching up with each and every one of you, hopefully soon at some point, maybe even at one of our 3-day events. We've just ran one this last weekend, and I look forward to seeing you guys again. Cheers, guys. Thank you very much. Bye.